Well, you know what I love are the conversations that we get to have, right?
Yeah.
And what I love so much about this industry, and having been fortunate to be able to be in the industry for now 24 years, is that we get to do this, right?
Yeah.
I mean, this is exciting, and fundamentally, what it boils down to is the network of relationships, and this is just an example of that. Every conversation that we've had, that we've gotten into, matters and is meaningful. And that's really the idea here, is that we have meaningful conversations and discussions around the current landscape. You know, there's regulatory factors, and along with that means that there's significant opportunity. And with that opportunity comes responsibility. And it can be done and done well. And having had the opportunity to work with a variety of both fintechs, being part of a bank, helping banks, and working with banks, there's this cross intersection of where it can be done and done well with the right partnerships. So looking forward to the conversation today and covering a lot of topics and fundamentally getting down to what we can do to really make a difference. That this isn't another pebble that we're tossing into the pond. You know, we want this to rise the tide here, and that's the
Yeah.
goal here. We can have meaningful content, conversations, and um, first time kind of doing this together with the team. And so look forward to conversations, questions. This is an open forum. You know, my view on what I get to do every day is that I'm a connector and a facilitator. And fortunately, I've been in the industry for a lot longer than I probably look. Like I'm older than I look. And but along with that comes the opportunity to have had many relationships, having launched many variety of programs, and built what I would say successful endeavors, you know, that benefit banks and fintech partners with a long-term view. So I love it, and we're just in the beginning. You know, we look at this industry now, and there's been technology and innovation, and a lot is on the table here. And you know, a lot of times I think about fundamentally what drives my motivations here. And I think a lot of it is, you know, having myself grown up in a small town, and
Mhm.
you know, I looked at the community bank in our small town as a pillar of the community, right? They the bank was lending locally, exciting events would happen. And I remember back in the day when I was a little kid, going through the drive-through, at the bank. At that time, airdrop meant, you know, the canister that we would put our deposits into, and the bank would always return the canister with hard candies or something, right? And so at a young age, I had this positive experience with the bank. I saw the bank's brand, you know, advertising local events involved with sports and high school activities, and it was the bank and the community that was really foundational. So I look at that now, and I look at what challenges the banks are facing in terms of creating differentiation, having the opportunity to expand into new areas of deposit and fee income diversification. And so we're here to talk about some of those areas. And again, just look forward to the conversation.
All right. Well, let's roll that conversation off, man. So I think I'm going to skip any sort of association BS or updates, and there's tons going on. And so I don't want to burn down everybody's time with that. But I did want to at least mention we've got some new guidance out. We'll be obviously sending that out to everybody. If you're not familiar, just keep your eyes open. We'll shoot it to you and do a little bit of a breakout of what it means. I think net, it's more fire and brimstone on the connector model and more thumbs up on the direct model. And I'm sure Darren will hit on some of that today. I think the other message is that from the regulatory environment, pretty, you know, maybe witch hunt's a strong word, maybe it's not. You be the judge. But the sector environment continues to devolve into more and more chaos. So that side of the world is more and more publicly and more outspoken from the regulatory environment, not the way to go. And, you know, words like risk and safety and soundness and all that documentation. So keep an eye out there. We'll shoot out some info. But I'm super excited to introduce Darren today, who knows all this stuff probably better than anybody. Definitely an OG at this, been around for a long time doing all these parts and pieces. And I think, as we talk through topics together, talking through lessons learned. So a little bit of for lack of a better term, kind of not necessarily the history book up until now, but what are the key takeaways? And I think some of the things Darren's got to take away today, for everybody, this is the one where we should all be taking notes. There's some really good parts and pieces. So I'm going to shut up. Davey, you got anything?
I think the big thing I want everybody to kind of catch is I do believe some of the recent guidance is a massive change, particularly on the word FDIC or the use of the word pass through. So I think what we've really got to regroup here is that we're going to tell you, sure, do it your way. We do it any way you want, but here's what you're going to be held accountable to. I would translate that into I dare you. And I think that's what we really need to take away from some of that. And so there is a right way to do this. And again, you know, this is why we want people to join the BaaS Association so we can bring people like Darren here to talk this stuff through. I'm not going to sit and represent that we know everything. We're pretty good, but we can help a lot of bankers. We can help a lot of fintechs. But mostly, I want to see you guys help each other and just be a facilitator of that.
Yep. Darren, I'm going to kick it off to you. Just so everybody knows, as always, we'll let Darren roll for, 5 or 10 minutes at a time, collect some questions. So shoot any questions you have over to us as you get rolling. And Darren, I will go invisible and then I'll jump up and wave my arms and
Okay.
let you know we got questions, man.
Sounds good. Okay. Thanks again, Dave and Tanner, for the opportunity to be here today. And what I wanted to start off with is just kind of painting the high level picture of areas that we're going to talk about today. So first off, we'll be talking a bit about the regulatory landscape and what are some of those proactive navigation strategies that banks can invoke and to one, not only understand the importance of this, but also adapt. We'll also get into some conversations about the incremental approach to this versus the analysis paralysis. This is one of the things that I love talking about with Dave and Tanner is banks need to make decisions and observations that we've seen myself in some experiences that sometimes that point of decisions and how a bank makes decisions sometimes gets drawn out and ultimately there needs to be a decision made. So really talking through some of the benefits of taking small, manageable steps toward some of these new endeavors. We'll talk about what's in it for the bank. Ultimately, what we're discussing here is creating avenues for lower cost deposit opportunities, as well as diversifying into new channels of fee income. So we'll talk about partnerships. We'll talk about some initiatives. We'll even go into some examples of what those look like. In addition, we'll talk about leveraging partnerships and compliance service models, how banks can utilize tools and how these tools are becoming very available and affordable and very reasonable in terms of a significant return to the bank, and at the same time bring expertise to maintain, which is the foundational bedrock, which is compliance and control of these programs to mitigate risk and exposure. We'll also talk about banks somewhat evolving the paradigm to think of the bank as a entrepreneurial community as well as an innovator in the space. We have a handful of case studies, depending on how much time we have, to talk about some real world examples of successful community banks that have been able to endeavor with these sorts of activities. So this is the high level area that we'll be talking about today and looking forward to getting into it. I also want to cover just a little bit in terms of painting the picture in terms of the outlook. And this is another area, Dave Tanner and I have discussed in the past as well in some of our conversations, is that the volume within fintech continues to grow. Yes, we do see fintech examples and consent orders out there that paint the picture that the industry is potentially contracting or facing significant challenges. Now, these are significant and important lessons to be learned. However, if you look at the big picture and look at the outlook of what volume is processing and currently running through fintech banks and compliant programs, it can be done and done well, and it's substantial, and there's significant opportunity. If we look at just some examples here, the outlook from Bain and Company back in 2022 forecasted that by 2026, 51 billion revenue from embedded finance, which would include a variety of endeavors within fintech, is expected to be here by 2026. 32 billion banking revenue from SMEs expected to shift to embedded finance by 2025, and that your projected total volume of financial transactions from fintech and embedded finance is projected to be 7 trillion by 2026. So this represents a significant opportunity. And along those same lines, with that opportunity comes responsibility, and responsibility in many, many areas. What's also interesting is you look at the landscape in terms of where the market is today with banks. So the observation that we're seeing here is that a significant number of the banks, definitely over half of the banks, are considering some sort of a fintech strategy in some capacity. However, if we really look at it, less than 5% are actually in a position that can support it or are supporting it today. And there's a lot of examples of things that we can now learn from, given the trends and information that we're now able to all get access to via the recent FDIC consent orders and other examples here. So I'll go ahead and Dave and Tanner and pause there for a moment. Is that a good 5-minute stopping point there?
Good spot, man. So I was going to hit you with a couple. One way to kind of size the market as of today, if you just looked at the BaaS Association membership from the bank's perspective, pretty much you could grab a handful. And we've done this as we've kind of benchmarked and built out. You grab 5 or 6 of our BaaS Association banks, and pretty quickly we reached more cards and more accounts than the big 4 combined. Right. Which is shocking, right? And so if you looked at the scope of, so quick numbers, we're at 143 BaaS banks today, right around 800 programs underneath those. While that's mostly community banks, regionals, very little going on. I mean, we all know there's a little bit, but very little going on thus far from the big guys, starting to shift that way. Just that small pool of very community and regional focus is much, much bigger than what the large guys have, even as a cumulative total. So what's the opportunity? All of it. I mean, This is awesome. So I think I've been a little frustrated, and I think, Darren, you probably feel the same way. I think, a very small segment of that connector, middleware side of the business, which is a small group, guys. We're talking about 20 institutions of the 140. Just FYI, I've been getting this call a lot the last few weeks of, are there any banks that aren't using the platforms and the connectors? And it's like, yeah, like 85% of them doing it the right way. So there's really big opportunity. The things you see in the news are a very small percentage of, the bad actor or problem crowd. And even a lot of that, man, we've had good conversations with people that are, making moves and taking the right steps. So the opportunity is large. The scary news is smaller than it sounds. And I think unless somebody decides we're just going to turn fintech off, and I mean, pretty much turn embedded finance off, then there's no doom and gloom conversation.
I do believe also that, to address these numbers perfectly, it was a big hurdle when we're talking about the 10 billion exempt and all that. Now you're seeing, of course, we got Chase, we got Fifth Third is really making some moves into all of this. These are banks well above 10 billion, and embedded finance is the reason. So Agreed. BaaS embedded finance is now becoming to a point to where, hold a minute, let's regroup, rethink this thing. Who gives a hell? Damn, they're over 10 billion or below 10 billion. There's a huge opportunity here. I think that should kind of clue all of the banks below 10 billion to how great of an opportunity this really is.
Fully agreed. Completely agree with you on those areas. Now, in terms of some of the examples that we're seeing as it relates to the regulatory findings and some of the summaries of reading these consent orders, I mean, there's really good reading material out there. But I'm going to consolidate and save everyone a little bit of time. If you haven't had a chance to read all of them, it seems on a regular basis we're seeing them come out. But there's some common trends. some of the common trends that we're seeing with these regulatory findings and a summary of it is that the enforcement actions involve really board governance, compliance management systems, third-party risk management, and really the oversight of those areas. And significantly, we're seeing areas such as consumer compliance, BSA, AML. And so there's a lot of playbook opportunities to look at here and ensure that as a bank, that you're really understanding and you're putting the proper practices in place to avoid those issues and those situations. Um, some of the strategies that we see happening that are proactive, helping banks navigate the current regulatory landscape. It really starts at the top, the leadership. The banks that we see that are doing well within fintech and growing in these areas are those that have been able to build a foundation and an industry kind of awareness and almost authority that they've cultivated a culture of compliance within the bank. And this comes from the bank really creating not an experimental approach to this, but more of a long-term view. That if the bank is making a decision to get into it, they're doing it with the end in mind. They're building an overall strategy, and they're taking the proper steps to move it forward, to present the strategy and the program to the board. Board is involved, and not only in preliminary planning, but also decision making and implementation. Um, in addition to this, banks that are very savvy in terms of really understanding the importance of the relationship is also one that should be beneficial to the bank. So having a good discipline and a structure in place within the bank to really understand each fintech opportunity and to evaluate deposit opportunities and fee income opportunities to overall assess the financial impact to the bank and to ensure that the program will perform well and it'll be a profitable relationship to the bank. That it won't be a program that will be difficult to onboard and perhaps maybe won't have the deposits or the transactional activity to sustain the required internal ongoing monitoring of that relationship. One of the things that we were talking about as we were getting into preparing for this webinar today was about trust. And I think fundamentally what it gets down to is that bank building relationships across the spectrum that are built on trust, and that starts with the regulators creating trust and confidence with the regulators of the bank knows what it's doing. It has the proper individuals with the right training and credentials within the bank and the right tools to be able to manage all of these aspects of risk as it relates to these types of programs. And that trust and relationship extends beyond the regulators, but goes to the partners as well as the customers. And this is an opportunity that I see happening with clients that have banked and perhaps they're concerned about their current bank partner, and they're looking for diversification or redundancy, or they're looking to potentially replace because they're not quite confident that the bank may be the long-term relationship for them because they may be missing or not performing as they expected the relationship to. And really also getting back to the people, having an experienced and qualified team, and everyone has a clear understanding of what the fintech programs are and how to describe them, and both internally as well as externally within the organization and outside the organization. It's also very important that the banks have on-staff compliance and subject matter experts for unique markets where we see segments of particular opportunity generally gets into unique markets, emerging markets that in a lot of cases are higher regulated industries that can be banked and can be beneficial to the bank, but do require deep subject matter expertise around licensing and compliance factors based on regionals. So having the team and the compliance subject matter experts on board of the bank is foundationally important.
Just one note there, Darren, that has struck me, and I've been thinking on, it feels like, you remember the old days when we'd always talk about compliance burden, regulatory burden, you know? And it's like, I feel like we're still having all those same conversations and how important it is. And it's so much more, vast than it used to be. But it's kind of like the regulatory opportunity, right? This is how we leverage our most valuable asset, which is the charter. And if we can get good at that burden and turn it into an offensive weapon, these are the folks that are winning. I mean, if we just ran some pure analysis and look from the financial side, the best in the business, the charters that do the best in this area are typically able to extend that down and are able to do the best, right? Before you get in trouble. I mean, this is the game. So it's kind of a cool alternate way to look at it.
Absolutely. Yeah, and it's kind of neat to see that perspective begin to cultivate and grow in the industry. And again, it was as I was mentioning earlier, I love the conversations that we always have, and I would say, one of the things that we're really talking about is within our industry, within banking and fintech, creating that natural kind of evolution and ecosystem of cooperation, where now those themes and that culture is evolving and kind of percolating throughout the industry, both banking and fintech. And as those intersections merge, we come out with a better, stronger outcome.
Yeah. And guys, if you have any questions, toss them in the chat.
All right.
I'm excited for this. Go ahead.
Okay, we'll dive into a little bit to what we've seen in terms of best practices within the banks that are really doing well in these areas. So first off, it gets down, and when I'm having conversations with both fintechs and banks, the discussion around people, policy, process, procedures, and the technology. I mean, those are the foundational areas. And within the banks, banks that they're doing this well have built out and approved, along with their board, a clearly defined fintech policy that defines the purpose of the fintech program, the scope of the program, and what its objectives are. And along those same lines, defining specific verticals, and having alignment with the bank's risk and subject matter expertise. And this is an area where I see banks that do very well. They identify very clearly what are the industry types that they know well. If you think about regulated industries, bank fintechs that require specific licensing. Examples of that would be money service businesses, licensed sports betting platforms, digital assets and cryptocurrencies. These are all opportunity segments that can be done well. And as banks really understand and become subject matter experts in these areas, that helps the bank to define specific verticals. There's also benefit to fintechs in having more banks come into the market to support the industry growth, right? I mean, these industries are growing. They're looking for trusted bank partners that really, really get it, that are in it for the long term. So defining those verticals, becoming well-known in the industry for being an expert and a trusted bank partner in defined verticals is an opportunity for the banks to really get in and diversify their deposit strategies, but as well create some differentiation in the market. And there's a lot of growth there, a lot of opportunity for banks to come in and fill those open positions. In addition here, it was those industry types are clearly defined, creating a very clear and concise risk evaluation per industry, that involves oversight and management. Again, this kind of goes back to some of the topics we were talking about earlier, guys, around having that incremental process versus analysis paralysis. This gets into creating decisioning authority, having points of qualification within opportunities, really defining program types that reflect the type of transactional activities and what sort of fintech clients. And along those same lines, helps the bank to really kind of define and productize its fintech treasury offerings, as well as the transaction types that the bank can support and is well enabled to from a compliance and transaction monitoring side, as well as enabling payment methods and payment rails for these fintechs. What's also important as well with banks in terms of the consideration evaluations is to ensure that bank has a well-rounded and disciplined structure in terms of defining program types and how that relates to concentration ratios. We've seen examples of financial institutions came into the market over extended themselves in terms of specializing in one particular vertical, and when that particular vertical had regulatory compliance challenges, deposits ran away from those banks, and now those banks are in the history books. So having a well-disciplined structure and defined within bank fintech policy, defined concentration ratios helps the bank to, again, define its decisioning process and to also protect against any particular industry that may have a challenge or a problem, having a balance of those concentration ratios. So I'll pause there if there's anything that we want to chime in on those topics. Otherwise, I can.
That was great.
Yeah, I think Tanner's got a couple of questions there, but I want to just pound the table a little bit on what we're talking about with the risk evaluation. I think there's a big piece right there that I don't think a lot of banks have a lot of talent at being able to understand and evaluate a fintech. So there's a place where you could really up your game. The concentration ratio, you'll hear a lot from the regulators about, and the bank will turn around and tell you, oh, we're in trouble because we grew too fast. That's not exactly true. But there is a way that you can grow fast as long as you're balancing your balance sheet along the way. So it's both an income issue and a deposit issue, or an asset versus liability side.
Couple of quickies for you, Darren. So Jessica's got a great one. She says, can you repeat the offensive standard? As someone who's been in compliance for a long time, compliance is normally seen as something to get around instead of planning for and with. I love that. I completely agree.
Yeah.
So,
Yeah, and one of the terms that I love to use in internally and externally, I share this with clients all the time, is that compliance is the tip of the spear, right? Nothing else matters without compliance, right? So it begins with that. And one approach that we have with fintechs, and I'll kind of shift it to the fintech side of the equation. When we're having discussions with fintechs, and my observation, having been in the industry for 24 years plus, is that fintechs don't always know how to approach a bank and have that kind of conversation with the bank and speak banking. And they're coming in and they're approaching it from hey, the bank is the bank is going to be selling to us. And fundamentally, what it really gets down to is getting the bank comfortable with the fintech from an exposure to the bank. So truly, as it relates to the compliance side of it, it really is the tip of the spear. So one approach that I've worked with fintech relationships is building out a simplified fintech questionnaire, which covers high level kind of the idea of the questionnaire is to have the bank provide short summary of the key areas that ultimately will be part of and significant within the enhanced risk assessment process. When you really get into the weeds where you're getting AML policies, processes, procedures fully evaluated. But to go through the questionnaire, it's a 2-page questionnaire, and we hit on these key topics. And it's there that we really identify if there are any gaps, and so before really even moving into the conversation and taking resource, time, energy, effort from the fintech is that we evaluate those compliance areas as it relates to meeting the requirements for the program type within the bank. And it also allows us to assess those areas. If there's gaps, then we know where we need to focus in order to prepare to have a complete and comprehensive fintech application for the bank, right? So fundamentally, it's not skirting around and avoiding the compliance piece. It's facing the compliance first and ensuring that you've got that in place to move forward with the bank. It's a good qualifier as well for opportunities. to ensure that they're a good strategic fit for the bank, that they have all those products and services and compliance measures in place to be a long-term profitable relationship with the bank. So it's foundational, and I look at it as the starting point.
Good call. All right. So one from Sarah, she says, with your client base, have you seen the board at any banks getting nervous with regard to ongoing consent orders? Or do you see banks and their respective board members still keen and eager to enhance their portfolio by becoming a sponsor bank for these new and upcoming fintechs?
Mhm.
I would tell you it is hardcore one or the other. And I think the ones that are pulling back are making a huge mistake because, I mean, we talked about those volumes at the beginning, right? And I think we're also seeing, and Darren, we talked some about this, what used to be so fintech focused, kind of challengery, right, is now moved into commercial customers and brands, right? And I think that's why we're seeing a lot from larger banks getting into the space. They're trying to play defense with their commercial customers because they're being stolen. I mean,
Mhm.
a lot of folks that are on this call, the best of the best BaaS banks are out there with an offensive strategy, taking commercial clients away. So I think my answer would be it's a mixture. There's definitely some people that are freaked out with the recent news, and I think that is a huge mistake. I think we're talking about a shift from offense in BaaS to defense, kind of a must-have in the future. That's just my 2 cents.
Completely agree with you. And to answer the question also from my perspective is that I agree with you on that, Tanner, is that we see both spectrums. We see banks that look at the consent orders and the information out there as valuable information. It's like they now have that opportunity to look at what went wrong and to evaluate and take an honest assessment and to look at where if there's any deficiencies or gaps that they're getting ahead of it and they're being proactive in terms of ensuring that the bank doesn't end up in a similar headlines. And then others that, certainly are looking at it from, cautionary where they're, nervous to make changes, but they realize they need to at some point. And this is something, we've had conversations about this too, is that there's um, a lot of folks that are on the sidelines and they're making strategic decisions. They know they need to make a decision. And this is where I believe that the BaaS Association, Bankers Helping Bankers, is foundational because this is a peer group, and we care about the bank being around and continuing to stay in business and serve the community. And so there are trusted resources and experience tools and partnerships, just like what we're talking about now, to help banks that may be a little bit nervous. What I also talk about with some of these banks that are, that are maybe nervous, afraid of change, is that it's okay to start small and it's okay to experiment in terms of very contained new endeavors, but at the same time, don't be afraid of evolving in these areas with the
Well
right
said.
partner. Yeah.
All right, one more from you. Might be a hard one because it's anonymous. All right. So, do you see many fintech companies classified as MSBs, money service businesses, leveraging exemptions in the rules by utilizing FBO or omnibus account models? Haven't found much guidance. And I would definitely agree on the guidance. And I think the lack of regulatory visibility, not for all of us, which is true, but I think even for the regulators having a lot of visibility there, it is a highly polarizing topic for those in the know. And so, Darren, I'll let you take a crack, man. That's one I have my opinions on that probably wouldn't be popular. I'll let you go.
Yeah, no, it's a great, and I love these questions. And these are the sorts of things that are fascinating, interesting about industry is the broad categories that are out there, and I look at these as opportunities. In terms of the MSB, money service business, that's one example, and I would say that there's other industries that are parallel to it, such as digital assets. And really what the definitions of that, because there are very interesting use cases there, and there's ways that it can be done well. My approach with this sort of money service business as an example as it relates to bank providing FBO. And I would define specifically an FBO account as a bank titled account. So this is an account that's set up under the bank's tax ID and ultimately the bank issued account, and it's titled for benefit of the fintech based on their licensing. So there's very kind of specific exposure that then occurs when a bank is essentially, opening that account. It's almost like the bank is now extending and opening a branch. It's like it's really got a, and so my approach with this one is that it's almost treated on a case by case basis,
Mhm.
because each use case is going to be very specific, and each use case, depending on the funds flow. And this is where we get into conversations really early on between the questionnaire with the fintech. We also get a funds flow diagram where we get into very specific detail around compliance, money movement, what payment protocols are being used, what volumes, and fundamentally getting to a very clear understanding about onboarding compliance checks and measures, surveillance of transactions throughout the system from end to end, and ultimately clearly identifying source of funds and ultimately the ultimate beneficiary. And how we really, really get into the specifics of that sounds complicated, but we take an approach where we make it more simple. And at that point, we really understand that exposure, because I believe that and similar to digital asset channels, there is definitely some area of lack of clarity on some of these. But at the same time, working through the right risk models and taking these opportunities on a case by case basis and evaluating them does create a path to opportunity there. But again, we don't have absolute clarity in all of areas, but there's certainly some guidance that we can evaluate on a case by case basis.
Well
That
said.
is the best answer I have ever heard in my life. You went through surveillance, you went through all of the different ownership structures and all of the use cases that come out of that. It's the details, guys. And I really, really like that answer. I hope somebody records that, takes a snippet, and plays it back to their board. That's
Yes.
excellent.
Good call. Good call. Darren, I got some more for you, but I wanted to let you keep rolling just for the sake of time. Let you cover a little ground and I'll pop back in.
Yeah, I'll run through some of these other areas pretty quickly, and we'll dive into some of the other examples. So I want to get into some use cases and what we're actually seeing in the marketplace today. But along those same lines, guys, the risk assessment process, really defining specific fintech verticals, program parameters, and risk assessments per vertical. And it can be done well. There's fantastic and amazing technology. It's getting better and better and more affordable and more accessible across the spectrum for both fintechs and banks. It's very important, and as we were discussing, ongoing monitoring and periodic reviews. These are not, relationships that you sign up and bank isn't talking to them again. No, this is truly a relationship. This is a culture. This is a connective tissue between the fintech and the bank. I mean, it's a lot of times much more than just a business relationship. It goes a lot deeper than that generally. We've got fantastic systems in ensuring that the banks have BSA, KYC, OFAC, AML risks identified, and those again get into specifics of the vertical. We've got third-party monitoring and oversight, and if you look at the consent orders that are out there and some of the actions, it's because there were not necessarily fully definitive third-party risk monitoring and oversight that was happening at the level based on the activities of the program and volumes. So there's opportunities here for banks to bring in real disciplines around monitoring and transaction surveillancing, defining and keeping up with fintechs, ensuring that those fintechs have the proper licensing and they're keeping up on those licenses, and also the adapting regulatory landscape. We see evolving industries, and with that come political changes and regulation as a result of that. Making sure that is maintained and kept up with. And then at the same time, we also see within the consent orders ensuring that programs that are in the market, fintech programs, are meeting the regulatory requirements as it relates to disclosures. And not only are they providing disclosures, but are they actually keeping up on them? Are they actually following through? Are they complying with those regulatory requirements as well? So certainly, this is we could have a full webinar on this topic alone, but it's very important. It's important the banks are thinking about this. And as it relates to the people side of the equation, ensuring that the teams are trained across all departments, Creating again, this goes back to the culture of compliance within the bank and the fintech organization as well, that it's a compliance forward, it's a compliance foundation and culture, and making sure that if there are any gaps, that the teams are trained and well educated on it, and have a foundational knowledge that they're confident in their understanding. And at the same time, again, tying back to the board, having this become a regular cadence within the board meetings every month, reporting on the fintech performance across the spectrum, not only financially, but also compliance. Are we seeing any indicators in the yellow? Are we seeing anything that's the red? What do we need to do? What should we do more of? And really getting the board involved is really, really key.
One quick pause for you. I got a hard one. You ready? Another anonymous one for you.
Okay.
So best practices to choosing a third-party auditor for BSA, AML, OFAC, and other areas that are required by your banking partner. Some bank partners give a list of preferred vendors, others say qualified auditors. If you're a fintech, what should you look for when you're evaluating partners? I think my first and foremost is I'm looking for a shift here. I have long thought, if everybody remembers a decade ago, banks looking at fintech partners as customers. And I think Darren, you said it well, now almost shifting into you need to pitch the bank and have these, safety and soundness measures in mind when you do so. I think the same is going to be true in the future of partners. I think the days of banks going out and writing a bazillion third-party interfaces and the management of all that, there's going to be more preference and closer tied partnerships, almost that look a little bit more like distribution that come into play. So I would say from a fintech standpoint, look at the banking ecosystem and what is, the most preferred amongst the most. So think market share trajectory. We can help you out with some of that, but that's just my 2 cents of what is maybe not best of breed. And this is a problem we all understand well on the banking side. The best products don't always win, but sometimes when you have that regulatory and that compliance mind's eye, sometimes what comes into play is who has the most market share, who's kind of the gold standard. And that gets you through things like an audit with a breeze, right? No problem going through those things. So you might be willing to give up some of that best of breed nature. And I know that sounds crazy, but in the banking environment, safety and numbers is a big thing, right? And so I would say at least keep that in mind. But at the same time, if you're a fintech, you're trying to drive differentiation, and that's a damn good place to do it, right? Be well ahead on this side and be a heck of a good partner for a bank is a great place to excel. What do you think, Darren?
That was a good answer.
Yeah, 100%. I fully agree with all of that. And what I wanted to also talk about in terms of best practice for choosing. Look, we're communities, right? Both on the fintech side, banking side, and there's intersections between. What I discuss, and I've had this sort of question before with specific fintechs in certain markets, is have conversations with your peers. Generally, innovators and entrepreneurs and founders and leaders within fintech organizations are well networked with companies in their industry, and generally they have pretty good relationships there. And so they're looking potentially at some of the products and services that they may be using as it relates to these services, qualified auditors, or tools that they may be considering. Talk to your friends and your peers, and there's no better validation than the testimony from a customer that's used the platform. So I think that's foundational is, have those conversations, and extend that with your trusted network of relationships, and ask the questions, because it's a very important aspect of the business. And my view is that typically folks want to help, they want to contribute, and there's a lot of information sharing out there, and so having those conversations with your peers and relationships that you have in your network to get reviews and recommendations goes a long way.
Perfect. Back to you, buddy.
Okay. All right. I want to take a minute and just talk a little bit about considerations as it relates to the financial impact to the bank. A lot of times when we think about our conversations with regulators and examiners, they're looking at the compliance, the risk exposure to the bank, for these sorts of programs. One of the areas that's an interesting consideration that I don't know gets covered as often is the review with the examiners around the programs to ensure that the programs are actually beneficial to the bank, right? And so taking things into consideration, such as the cost for onboarding and ongoing maintenance to support these programs. There are typically technology expenses that come into not only onboarding but supporting these fintech programs. Headcount, adding more individuals and subject matter experts grows the requirements for full-time employees, and in some cases, contractors having external legal, internal legal. So taking those factors into consideration, and really evaluating fintechs as part of the early stage discussion is to get a good understanding about potential revenue, from both deposit growth as well as non-interest income. These are examples would be one-time or onboarding setup fees, monthly program fees, transaction fee income, and then deposits. What kind of deposits are we looking at getting? Are we getting non-interest bearing deposits? Are these interest bearing deposits in building out some evaluation around deposit yields and what that looks like in terms of the overall financial impact to ensure that these relationships are actually financially beneficial as well as compliant for the bank. And really building this out, what we found is that it creates a really clearly defined strategic fit client profile for the bank. And it also helps with moving efficiently and effectively through pipeline discussions with these fintechs. Allows for kind of setting a clear expectation around financial and commercial term requirements, helps in building out term sheets and moving quickly through that process by having these clear, defined strategic fit profiles built out. And again, it gets back to one of the topics we have in our highlights here is really banks defining and creating an incremental approach versus an analysis paralysis. Not having a program come in and not having clearly defined process and bank not necessarily knowing how to treat or handle an opportunity can turn into a bit of a round robin scenario, which doesn't benefit anyone. So having these areas really defined allows for efficient pre-qualification, optimize the pipeline, and ultimately creating a great experience for everyone. And it's okay, to have conversations with fintechs. And, if it's not a good strategic fit, based on whether it is a deposit opportunity or a fee income opportunity, if it's not a good financial fit for the bank or a compliance fit for the bank, that's okay. But having these sorts of tools in place help to get there more quickly, and to get those answers and ultimately create a good experience for everyone involved.
I think that's great. The things that I think we're really saying here is responsibility. So if we start a journey, where are we going? Do I need my tennis shoes or my boots, or where are we going? I don't know where the final outcome is. If I can't define that, what are we really packing in our gear bag? All right. So if the banker can't clearly define where he's trying to go, it's hard to tell what the first or the second or the third step ought to be. That's their responsibility. Okay, the fintech, you should be able to talk to the banker and say, these are the needs we believe you're going to need on the compliance side. This is the staffing requirements. This is where we're going to affect your income statement, or this is how we're going to affect your call report. This is exactly what we're doing. If you're not prepared to do that, you're not ready yet. Likewise, when you put these two parties together and people can talk at that level with each other, you're going to pretty quickly define whether this is a good fit for you or not. And we stop wasting everybody's time. Back to the analysis paralysis. We're talking to people that are just buzzwording us to death, and we can't really understand where we're trying to go to, and we really don't know where we're trying to go. All right, that's inefficiency at its best. And I think a lot of these details that we're talking about are how some of these banks got in such a problem in the first place, they ceded the responsibility and the details to a third party, and that should have never been done.
Well said. I think too, Darren, tell me if you think I'm crazy, man. You mentioned Dad said the gear bag, you know, and I think I'm looking down in this gear bag at all these things necessary, and I look up and I'm like, Treasury, this is commercial banking. I mean, right? If we took some of the labels away, so much of what we're talking about and actually getting a little more sophisticated today, it looks a lot like Treasury. You know, I mean, this is I've been saying for years, I feel like we're coming up with all these different terms to fit specific industries like BaaS and embedded finance, but this is the evolution of commercial banking. And I think we've definitely from that lens, we've missed some duh moments, right? If you read the headlines, had we been thinking from that perspective, we wouldn't have missed. And likewise, I think there's other areas where we've become really sophisticated in areas that could be applied back to the Treasury Department, right? This is cool.
Yeah.
I think this is a good point, Tanner. And one last thing here, I want to kind of drive on. You don't have to be an idiot, right? So sometimes we look at things and go, this fintech says we don't have to do KYC and we can do these things. And it's like, man, I mean, that's like a red flare in the dark night. You should be able to go, hold on here. All right. Because somebody funds somebody and they think they've got an idea, doesn't mean it's sound just because they got $10 million in funding. Have some level of common sense to sit down and go, that doesn't smell right. And again, if you're not at that level of understanding of what regulations are and you're a banker, fire yourself and let somebody else do the job.
Spot on. Spot on. I love it. You know, and the other point that I wanted to stitch in here is kind of going back to the discussion about Treasury, and how what I've seen this happen in multiple, situations with a variety of banks, is how this creates it almost creates a connective tissue and breaks down sometimes in some cases silos between various departments within the bank, because when you're talking about programs that are now driving more lower cost deposits. Now, the lending side is happy because they have, better capital ratios and different, it's reducing, some of their key, KPIs. And you're now breaking down some of those, silos. And when that happens, there becomes a bit more of this culture of connection between various organizations within an operating bank, right? You're now collective. It's more of it's a joint effort versus us versus them. We're the treasury side, that's the payment side of the equation. When there's this, cooperation and collective and mutual understanding between the two areas, that's where the magic happens.
I hope I grow up to be as smart as you, man. I have some of the same thoughts, but it comes out as like squeaks and grunts. So you're too good, man. Keep it up.
I'm just fortunate to have been around as long as I've been and learned from the best like you guys. So that's what I attribute. I've been around great individuals, and fundamentally love what we get to do here. So thank you for that, and right back at you, both of you guys. You guys know I'm a huge fan of what Bankers Helping Bankers and BaaS Association, FinTech Cowboys, everything about it. So thank you for that, and just happy to be here and contributing to the greater cause here.
You bet.
One of the things I made sure to ask right before we got started here was to make sure he was going to be at the roundup. I believe that having people like you, and I can name a half a dozen others, that it's important that you don't listen to us all the time. I want this community to work its problems and its future out together, and it's got to be done with the smart people talking to each other in the room, not being talked to by others. And so I love it when we got smart people that can sit down and work together on things.
Absolutely. Yeah, and that's what matters, right? Is relationships, right? And so right there with you, guys. And I know we're blasting through the time. I can't believe it's already down to a few minutes left here, but a couple of areas that I want to cover here quickly is around kind of that proactive approach, both compliance as well as partnerships in this perspective, and we see it happening with banks evolving in terms of becoming like unlocking their charter, unlocking the potential, right? And now that becomes an entrepreneurial channel for the bank. And there's phenomenal resources, and just a couple here. So first off, I'll call out the test pilot environment. Before the call, promised Dave and Tanner, as an aviator and a pilot myself, I wouldn't get too far off into a tangent because I've heard that people, will say, "Hey, how can you tell if someone's a pilot?" You don't have to guess because they're going to tell you, and it's totally
Right.
true. But just the theme around, test pilots and, the resources and products and services that are there are incredible and spot on. So I think, I don't know, Dave and Tanner, if we want to talk a little bit about the test pilot environment, but, what a foundational, so, what a great resource that is at the fingertips, in the industry, right here. So if you guys want to talk a little bit about the test pilot environment, I can, share you some thoughts that I have on it, but, since you guys built it, you might talk about it.
I, I think the big thing, it's come up a number of times today, you have new areas and new companies and new products, and our regulatory and compliance framework is not meant for new, right? And so we sit down and look at this and say, if I need 3 references to get through an exam, then nothing would ever be born here, right? It's a little out of whack. We have a chicken and egg problem. And so that's definitely the first ethos behind things of let's get folks that'll get out there and test and try new things. And there's also a lot, we're all so fortunate to have some real rock star innovators, especially from the bank side, that are actually willing and know that environment well enough to get out there and test and try things. And I think for the fintech side of the folks on this call, right? You're sitting there thinking, man, we've created something really cool and I can't even get anybody to try it. I would
Right.
love to offer great incentives and everything else if I could get a real partner that would try it and tell me where I've made mistakes or get through things. So that's really where that came from. Just trying to get a group of folks together that are willing to go out and try things. And it's been really cool, man. We have a lot of fun there, as you might imagine.
Yeah, you could name a dozen companies. I mean, from the sardine alloy, Unit 21, we go down all that cable. I mean, there's a bunch of them that, hey, they started with no customers too. Now, if you're one of those companies and you think you're in big boy land and you're ready to go, okay, then come see it. We'll get you with some bankers that were willing to work with this process and become some of the references that you need. That's a big key missing piece because you can't get started without it. But also, when you're not even close, this isn't the time to go there because you'll burn your brand to the ground right there. So you've got to get yourself in a position to be ready, and then let's test this thing and make sure it is ready, and you'll find the whole banking community behind
Yeah, absolutely. Yeah, we love the theme. Banks need banks, fintechs need banks. It's community, right? And it can be done well with the collective. And there's a lot of opportunity to stitch together these resources. There's phenomenal resources here with the test pilots environments. We're seeing themes with platforms that are built by bankers or former bankers, such as Braid FI. Now allowing banks to really take control of the system, right? Allowing them to mitigate risks. These products and services are becoming more accessible, becoming better and better, affordable, and allows the bank to really itself become a fintech. And one of the themes, and my good friend Randy San Nicholas, founder of BraidFi, we have conversations about this all the time in terms of unlocking, fintech charters. And you think about it, look, there's smart young individuals, entrepreneurs that raise money, right? They raise capital, they have a great idea, and what do? They go partner with the bank. And if that can happen, and if they can build successful programs, well, why can't a community bank begin its transition and develop and become a supplier in the supply chain and become a fintech itself, right? I mean, it's it's like almost putting back,
you. And that's
in the
absolutely perfect because you've got two opportunities. One is to be, let's say, an enabler of embedded finance as a banker. You become a specialist at that, a BaaS bank, right? The other thing is there's nothing these guys are doing that you can't do yourself. So why be a specialist when you can be a specialist at both? And I love where you're at here because I think this is where the evolution of this goes. Because a banker can become a fintech, but a fintech can't become a bank.
Yeah, absolutely. And who should be in control? The bank, right?
Well, I'll tell you what, if you're a customer of Synapse and Evolve and all of the stuff that you've seen there, it should be pretty readily apparent to everybody where the buck stops. And
Uh-huh. Mhm.
creating situations that we know could expose people to a bankruptcy and months of waiting on their money to happen, we can do better than that. And it's not a case of the government needs to step up and take responsibility. It's the bankers need to step up and take responsibility.
Well said.
Exactly. Well,
Brandon, you got a minute or so to give final thoughts, man, if you want to run down. And I do want to give a final thought for you, just that you have been so helpful, and I haven't heard a single word of self-promotion
I
on
know,
how
I
great
love
what
this
you do.
guy.
Just call Darren if you need help with anything he's talked about today would be my big thing. But I appreciate you showing up and helping the community, man. We need more people
So
like you.
much.
But final
So
thoughts,
much.
go ahead.
Yeah, I appreciate you guys. And, I'm not good at self-promoting. I'm just a contributor. I like to, do my part and help, foundationally. And it works. What we're doing works. And I just wanted to share, here in the last 30 seconds while we're wrapping up and as the time clock is going down, this kind of makes me think, Tanner, one of the things you mentioned is that when you had the roundup, what you saw as success is that after time was up, the banks were still there in the room with the microphone talking, and it continued on after the time has expired. So this is kind of happening right now, but I want to at least share a couple of use cases of real world examples, right? And this is just one of many. I won't go into all the minutia and detail here, but fundamentally, this is happening with banks, small banks, under 100 million assets under management, all the way to the billion plus, financial institutions that are identifying unique opportunities and unlocking potentials, all right? And there's some examples here of banks that have, specifically partnered with some of the platforms that we're talking about today, and they've brought those services in-house, and it's grown immediate opportunities within bank to grow their capabilities, to create fee income, and to grow lower cost deposits and create stickier deposits, and at the same time create a great user experience across the board and comply. And that's foundationally the opportunity here. So I know we blasted through the time too quickly, probably skipped a lot of things, but appreciate Dave and Tanner, everything that you and the association are up to on every level. Appreciate everyone that was able to take the time out of a busy, work week to be here. And again, it was an honor to be here, and thanks again for the opportunity to be here today.
Aaron,
Thank you.
are we going to be able to make these slides available to people that come and pick up from?
Happy to share. Yeah. What's mine is yours. I'm Mikasa Sukasa.
Okay.
All right. Thank you so much. I can't say thank you enough. We appreciate you, man. And we're going to do more with you coming up.
Likewise, look forward to it.
All right. See you soon, guys.
All right.
Thanks, buddy.